According to a recent article from MarketWatch, the bull market in U.S. stocks is by one account the longest in history, but it may not be long for this world. According to one analyst, Barry Bannister, head of institutional equity strategy at Stifel, said in a note that it would be difficult to time the next bear market, but within 6 to 12 months seems assured. And since the 6 to 12 months, in my opinion, is not a very firm estimate, I'm calling it the Gummy Bear market. Let's take a look. A bear market is typically defined as a 20% decline from a peak. The S&P 500 hasn't seen a drop of that magnitude since March 2009, the bottom of the financial crisis, and what many people consider to be the start of the bull market. For years, the market has moved higher amid relatively subdued volatility. So far this year, the S&P 500 is up 7.3%, hitting records as recently as last week after tumbling into correction territory in February of this year. The Dow Jones Industrials had risen 4.6%, while the Nasdaq Composite has climbed nearly 15%. Barry Bannister's caution on stocks is tied to Federal Reserve policy, specifically expectations for continued rate increases. In March, he warned that a policy mistake from the Fed could spark an unusually fast bear market, as well as a lost decade for stocks or 10 years with no positive returns. He maintained the view in a note earlier this week, writing, "We see stocks falling faster than the Fed can react." He recommended investors position themselves defensively going into autumn. Bannister said stocks are in a danger zone based on the equity risk premium, or the earnings yield of the market minus the yield of the 10-year Treasury note. When the premium nears extreme levels, a short, sharp bear market often occurs. And as you can see in this chart here, you see the points at the bottom of the curve where we had sharp bear markets, including the post-war American high in 1961, the go-go market in December 1969, the pre-87 crash, the dot-com bubble peak January of 2000, and now we are approaching that line once again. And note that the great financial crisis, which occurred in 2008-2009, the level of the chart actually did not reach toward the bottom. So bear markets can occur prior to reaching that bottom arc. Rising interest rates would be the catalyst for the bear market, Bannister predicts. If the central bank hikes rates twice more than the Fed funds rate minus the neutral rate, could cross the bear market trigger as seen in this chart. The neutral rate is the level at which monetary policy neither cools down the economy nor stimulates it. The Fed most recently raised rates in June, boosting them to a range of 1.75 to 2%. It could do so twice more this year at its September and December meetings, something analysts said was more likely after the August jobs report showed strong wage growth. Although some say the neutral rate is difficult to observe, Bannister says stocks see the barrier quite clearly. A maximum tolerable peak for the Fed funds above the neutral rate has been associated with bear markets since the late 1990s global debt boom. Gains in the market in 2018 have come with signs of improving fundamentals, including the labor market and economic growth. Strong corporate profits has also boosted stocks, but the effectiveness of this tailwind would be diminished with rising rates. Bannister stated that as the Fed moves up to a 1.125% real rate by 2019, we see the S&P 500 price to earnings falling even as earnings per share rise. He foresees the Fed establishing a positive real cost for money for the first time in 10 years, causing PE ratios to suddenly derate in autumn 2018 and thereafter more gradually, which would top out the S&P 500. Bannister is not the only one turning cautious about stocks. Morgan Stanley has for months predicted a sharp sell-off in stocks, saying that a rolling bear market would soon hit some of the market sectors, including the tech and consumer discretionary groups that have supported the major indices this year. And we may have seen some of that last week. But let's keep our eye out. So for today, that's ChewDog Charts. Thank you.